Well, here's kind of an eye-opening fact about market volatility. 24 of the 25 best days in the market over the last 20 years happen within just 1 month of the 25 worst days. And Clint, I've heard this before, the best days follow the worst days, and it's one of those things people say a lot, but I think what you're going to walk us through will really help us understand in numbers how it works.
Yeah, absolutely. Sometimes it's surprising to hear these stats that the best days in the market are not too far away from some of those worst days that occur. So one of the things that we have been able to find in a recent study by BlackRock is that the market returns following a 10% market decline the following 12 months are almost 16% historically. When there is a market bottom, so 10% or worse that the market is down, the recovery is actually even greater. So in some of those worst times, the bounce back, the recovery over the next 12 months was actually over 24%. So what you can find is that in those dark times when that market is down, it's really the importance of having a plan and staying the course. Because if you were to make a rash decision, that could have a really negative impact. You wouldn't be able to benefit from that market recovery. Here's another part of that study that BlackRock did, and it just shows over the last 20 years, what would happen if you did move out of the market in those dark times and missed some of those best trading days. So let's just first say over the last 20 years that you kept your money in the market, you invested $100,000, and then over that 20-year time frame, what you'd find is that $100,000 would appreciate to $717,000. That is if you put money in and you kept it in there for the duration of that 20-year time frame. But we mentioned that there can be some people that might decide, hey, I want to move some of my money out to cash or onto the sidelines because just things have gotten too difficult. And if they were to do that, and if they were to miss 5 of those best days in the market over that same 20-year time frame, they wouldn't have $717,000 at the end. They would have only $452,000. Still a great return over time, but they have missed out on a substantial amount of growth just by moving out of the market at an inopportune time. Now, this study continues to go on. If you missed the 10 best days in the market over that 20-year time frame, your $100,000 would have only grown to $328,000. If you missed 15 days, $250,000. If you missed 20 days, $197,000. And if you missed 25 of the best market days over this, thousands of days over this 20-year time frame, your $100,000 would have only grown up to $158,000. So this really underscores the importance of staying in the market, having that plan, and how impactful it could be if you were to move money out of the market and miss some of those most opportune days.
As I listened to all that information that you gave, Clint, there's 2 really positive things that I take away from that. One is market volatility actually equals opportunity. Volatility equals opportunity because when the markets go down, that can represent some really good strategic opportunities if you have that plan put together, like what you said. The other positive note that I came away with from that information is market volatility is very predictable. Now, we don't always know what's going to cause market volatility, and we don't always know when we're going to come out of this market volatile event, but we have always come out of it. And if you take moves, you implement strategies while we're going through those different events, you can put yourself in a better place eventually when we do come out of it. And investing doesn't have to be all that difficult. The study that you just highlighted, basically, if you put your money in, you forgot about it completely over that time frame, you were in the best position than if you made some moves along the way. So investing itself doesn't have to be all that difficult. Where the complexity really comes into play is if you're a couple years away from retiring or you're in retirement and you have all these other moving parts that need to work in conjunction with your investment strategies. But that was really good news for a lot of people. Market volatility equals opportunity. Investing doesn't have to be all that hard, and market volatility is very predictable.